Today we'll be looking at the journal, also known as general journal. We'll be focusing on the correction of errors, and the errors that we're referring to are the ones that will not affect the trial balance agreement. But before we get into that, let us take a step back. The accounting cycle is what we will be engaging in, but what is the first step? The first step in the accounting cycle would be the transaction, the preparation of our source documents. Now, our source document, where would we be getting information or proof that a transaction took place? So we have our invoices, and those would be for our sales on credit or purchase on credit, or check stub, anytime we use any check to make payment, or receipt when we use cash, or credit note and our debit note. Those are indicators that goods were returned by the customers or we return goods to our suppliers. And finally, we have our petty cash voucher. As for small payments, so we'll have proof that those small payments took place. So there are others, but we'll just narrow on these few. The next step would be to prepare or enter the transactions in our books of original entry. These are the first set of books that we will actually note the transaction that took place based on what is on our source document. So we have books of original entry like our sales journal. The sales journal will have all of the information about our debtors or customers that took goods and have not paid us as yet, and so we'll record that information. If, however, our debtors decided that, hey, I don't want this item because there was an error in my order, I got the wrong item, there's some fault with the goods that I got, and they return it to us. There are other reasons, but just to name a few, they would return it to us. We cannot write it in our sales journal because that's not a sale. They actually return the goods that we sold to them. So we're going to write that in our return inwards journal. If we as a business decided to go out and purchase some stock from our suppliers and we took it on credit, we did not pay for it, we are going to enter that information in our purchases journal. For whatever reason, there's any fault, the wrong order, wrong size, anything like that, we'll return it to our suppliers. Again, you cannot put it in the book that you wrote it in when you purchased it. So you have to document it in another journal, and that is your return outwards journal. Whenever there's any cash transaction, so you purchase things using cash or you sell things using cash, you're going to enter it in your cash book. Now, if you look, you recognize that there's an asterisk beside the cash book. Reason being, the cash book is, yes, a book of original entry, but it also is a part of the ledgers. Why? The cash book carries both a debit side and a credit side, so the double entry process can take place in the cash book. So it's both a book of original entry as well as a ledger, which we'll talk a little bit more as time goes by. Then we have our petty cash book. Petty cash book is for small transaction, as I said earlier about the petty cash voucher. So the information from the voucher, I will place it in my petty cash book to show that some payment was done. And the last book of original entry would be our general journal. That's what we're going to be looking at today in more detail. The general journal will hold everything else. So if it cannot go into the sales journal, return inwards, purchases, return outward, cash book, petty cash book, then we'll definitely have to put it in the general journal to show that that transaction took place. So for example, I sell an asset on credit. I didn't use cash, so it couldn't go in the cash book. I cannot put it in my sales journal because it was not a goods. It's an actual fixed asset, so I cannot put it in the sales journal. So the best place to have it is my general journal. So let's continue. The third step would be to post all that you have from your books of original entry into your ledgers. What are your ledgers? Sales ledger, purchases ledger, general ledger. And yes, as stated before, your cash book and your petty cash book has a double entry system in it as well, so they will be considered ledgers as well. So let's continue. we have our trial balance. So after you have your transactions completed and you take the information from your source documents and enter them into your books of original entry, you will then post to the ledgers. And once you have completed posting to the ledgers for the entire period, you're going to close off those accounts. Once those accounts are closed off or balanced off, the final figure or the balances on those accounts, a list of them, will be used to create our trial balance. And the one we're referring to is the unadjusted one. There's no adjustments being made to it. So with all that said, there are times when errors are made while we're entering information from our books of original entry into our ledgers. So errors can be made, but what we're focusing on are the errors that when they're made, they do not affect our trial balance. So our trial balance, the errors will result in the same amount on the debit side and the same amount on the credit side. So no entry has been made on either the debit or the credit side, so the balance will be even. The balance will be the same. So for example, with this diagram that I'm showing you, you'll recognize that the trial balance figures are the same. So what I'm saying is that a transaction could have been done and an error was made in any of these accounts, but because it was made on both the debit or the credit side, then you will not see any difference in the total, and it will seem as though these are equal, everything is fine, but there are errors. So these errors will result in the trial balance still having balanced figure on both sides. So most errors are found at a later date. So it's not that we find them right away. So once we find them some point after it was recorded, we will have to correct them. As you know, we're not able to draw a line through the error and to remove it like that or delete it. We have to show proper accounting steps in showing persons that an error was made and it was corrected. So first thing we're going to do is to show the correction or corrections by making of journal entry, and as we refer to the general journal, and then the next step is to show the correction in the double entry set of accounts by posting these journal entries to the ledger accounts affected. So I'm going to do the journal, and once the journal entry is made, we're then going to post it to the different accounts that are affected. So let's start looking at the errors. The first error that we have is the error of commission. What do we mean by that? These are errors that the correct amount is entered, but in the wrong person's account. So, for example, T Long paid us by check $50 on May 18, 2005. It is correctly entered in the cash book. So there's nothing wrong with the cash book. So the $50 was entered, but it was entered by mistake into the account of T Lee. So if you look at it, it's T Long, T and L, and you can easily make a mistake and put it in T Lee's account instead of T Long. So the error was found on May 31st. So we will have to make a correction to this error. So again, error of commission is where the right amount was entered but in the wrong person's account. So in order to make this correction, we will have to remove it from T Lee's account and place it into T Long's account. Now it's a payment. So T Long paid us. Therefore, in the cash book, it would be on the debit side, and in T Long's account, it would be on the credit side. But unfortunately, we had placed it on the credit side for T Lee. So to show that it is being removed, we're going to have to debit T Lee to cancel it out of his account, and we will credit T Long's account where it should have been in the first place. Our narrative would be correction of errors of commission, cash entered in the wrong person's account. So originally it should have been entered on the credit side in T Long's account. It was not. It was placed in T Lee's account. So we're going to have to take it out of T Lee's account and make the correction in T Long. So this is it. So in T Long's account, we're going to show the credit entry, but we're going to have to write the detail of the other account that is affected, and the other account affected was T Lee. And we have error corrected, and then in T Lee's account, we are going to put on the debit side T Long error corrected, and that will be found in the sales ledger, and it is going to be $50. Let us continue. The next error is the error of principal. This is where an item is in the wrong type of account. For example, the purchase of a fixed asset is entered in an expense account. Now, it occurs when both accounts have a debit balance or both accounts have a credit balance. Example, the purchase of motor van $5,500 by check on May 14, 2005 have been debited to the in error to motor expense account. In the cash book, it is shown correctly, and the error was found on May 31st, 2005. So the cash book is fine. The problem is that the amount of $5,500 was not placed in the motor van account. It was instead placed in the motor expense account. Now, motor expenses and motor van are both debit account or carry debit balances. So there would be no problem in the trial balance because both are debited and the cash book is already credited. So it will be even. However, it was the wrong type of account that it was entered into. So to make a correction, we have to show the journal entry first. So the correct account that should have been debited would have been the motor van. So we have motor van. We can find that in the general ledger, $5,500. It is in the motor expense on the debit side, so we need to remove it. So we're going to write on the opposite side to show that we are removing the $5,500. So we're going to credit motor expenses, general ledger, with the $5,500. The narrative, correction of error of principal, purchase of motor van entered into motor expenses account. Again, because motor expenses carries a debit balance, it wouldn't affect the trial balance figure, total figure. However, it is incorrect. It's a wrong principle. It should have been placed in the fixed asset account, but instead it was placed in the motor expense. So to take it out, we'll debit the right account and credit motor expense to remove it from motor expense and have it in the right account. So just to show the posting of this entry, so motor van would be debited with motor expense error corrected, and motor expense would be credited. Now, before you definitely would have the entry on the debit side, so you'll have to put it on the credit side to remove it. Number 3, error of original entry. Now, this is where an item is entered, but both debit and credit entries are of the same incorrect amount. So on the debit side, we wrote the wrong figure, and on the credit side, or the account that was debited, we wrote the wrong figure, and the account that should have been credited, we wrote the wrong figure, the same amount. For example, our sales of $150 to T. Marley on May 13, 2005 had been entered as both a debit and credit of $130. So as you can see, it should have been 150, but we entered 130 on both sides. So it wasn't a case where one side was 150 and the other was 130, but both sides we wrote the wrong figure. So it is short by $20 because it's 150 minus 130. So we're short by $20. So sales is short by 20 and T. Marley is short by $20. So how are we going to go about fixing that? So the first thing we will do is to debit T. Marley because we had a sales and the sale was on credit to T. Marley, and we would have debited T. Marley's account in the first place and credit sales to show the transaction. So we're going to debit T. Marley with the additional $20, and we can find her or his account in sales ledger, and then we're going to credit sales in the general ledger with the $20 to add up, because we already had 130 in the account. It's short by 20, so all we have to do is place the 20 on the correct side to increase both sides to the 150. So the narrative is correction of errors of original entry, sales of $150 incorrectly entered as $130. Again, we can't just go in and cross out or draw a line through the 130 and write 150. That's not the correct accounting principle. The right thing to do is to actually make a correction for your error using the general journal or the journal. So just write in the account that should be increased on the debit side and the other that should be increased on the credit side. All right. So this would be our ledgers. So T Marley in the sales ledger would be debited, and our detail would be sales error corrected. That's the other account that is affected, and the amount, and then sales account in the general ledger on the credit side will have T Marley error corrected $20. So I hope you understand that. The only reason why we placed $20 is because both sides are short by $20. If we had written the 150, then it would have increased it to 280. So it's the difference that you have to put in. All right. Let's move on to error of omission. Now, error of omission is where a transaction is completely left out, omitted from the books, or they are not entered at all. So when we said error of omission is where you did not enter it at all in the ledgers or in the books of original entry, therefore it was not posted to the ledgers, and then it's just not there in any of your books. For example, purchase goods from C. Richards. So if we purchase goods from C. Richards, the account would be purchases and C. Richards for $250 was not entered in the account. The error was found on May 31st, 2005. So we did purchase goods, which would be on credit, from C. Richards. On a normal basis, you would have credited C. Richards and debit your purchase, but we did not enter this at all in the books, and so we're going to have to create our journal entry to show that we are correcting an error. So in the journal, we're going to debit our purchases with the $250. Purchases can be found in the general ledger, and then we're going to credit, as we know, we indent, credit C. Richards, which should be in the purchases ledger, with the $250. Correction of error of omission, goods purchased from C. Richards was left out. So we're just telling persons or whomever is looking on what took place. So this error is error of omission. The entry was never made in any other books, or it was omitted from the ledgers, and so we have to make that correction. All right. So let us look at the accounts. Again, the journal is just a diary stating what should be debited and what should be credited. So we'll just do the same thing with the purchases. We said we'll debit purchases. We write the detail of the other account that is affected as well. That account can be found in the purchases ledger, and the amount is $2,500. C. Richards is the other account affected is purchases. That can be found in the general ledger, and the amount is $250. So we have to make that entry. Now the next error that we may come upon is complete reversal of entries. Now, complete reversal of entry, this is when the correct amount are entered in the correct account, but each item is shown on the wrong side of each account. So if it should be on the debit side, you accidentally put it on the credit side, and in the other account it should have been on the credit side and you put it on the debit side. So it would not affect the balance of the trial balance agreeing. So we're gonna have to fix it so you have it on the wrong sides. All right. So for example, we paid a check of $200 on the 28th of May 2005 to D. Clark. So we made a payment. So if we use a check, it means that our bank account would have been affected. It would decrease because we're paying. So that should have been on the credit side, should have. And we're paying D. Charles, who is a creditor. Therefore, when you're paying your creditor, it is decreasing the liability, how much you owe the creditor. So it should have been debited. So bank should have been credited and the creditor should have been debited. However, you put it on the wrong side. All right, so let us explain. The amount is actually $200, right? But in the journal, you recognize that they have 400. Now let's reason it out. It was a right account, but on the wrong side, right? So we paid check means that our check account is decreasing, therefore it would have been on the credit side. But unfortunately, we did not put it on the credit side, we put it on the debit side as though we are getting money. And in D. Charles' account, we did not put it on the debit side as we should have because the liability is decreasing. We placed it on the credit side to show that D. Charles, we owe more money to D. Charles. So in order to cancel out the errors that we have made and put the right amount on the right side, we're going to multiply the 200 by 2 to get 400. So we're going to debit D. Charles. The first $200 is going to cancel out the amount that we had put on the credit side. And the other 200 will be the right entry. And for the bank, we're going to credit bank with 400. $200 of that will cancel out the $200 that we had placed on the debit side. And the other 200 would be the correct entry. So here is our account. So in the bank account, you will find on the credit side, D. Charles, error corrected, purchase ledger 400. And then we have D. Charles account, which should be in the purchase ledger. You will have a debit entry with bank, error corrected, cash book, $400. All right, so I hope you do understand as to why we did not put the $200, because if I had placed $200, all it would have done is to cancel out the error that was made, and the $200 would not be entered on the correct side. So I'd have to double the amount, so it cancel out the original entry that was made incorrectly, and then place the other $200 where it ought to be. So our sixth error is the compensating error. This is where two errors of equal amount put on opposite side of the account cancel each other out. So, for example, the sales journal or credit sales is added up to be $100 too much. In the same period, the purchases journal credit purchases is also added up to be $100 too much. So, sales would have been credited, purchases would have been debited. And because both of them were added up, they were over by 100, they basically cancel out each other. So your trial balance figure or total would be the same because of the fact that both sides were over by the same amount. So let us look at that. How would I correct this error? So sales is over by $100. Sales, as I said, credit sales normally carry a credit balance. So it would have been over on the credit side. So in order to reduce it by the $100, I'm going to debit sales in my general ledger by the $100. Purchases is normally on the debit side. It would have been over by 100, and so I credit purchases with the $100 and state my narrative: correction of compensating error, sales and purchase journal incorrectly added up $100 too much. So if it was one was 100, one was 150, then automatically the trial balance would not agree. But because both of them were over by the 100, they actually caused the trial balance to agree. So in order to reduce it, to bring it to the correct amount, you will have to put it on the opposite side to reduce it. If, however, it was where your sales was too small or undercast and your purchases was undercast by the 100, then we would have done the opposite. So we would have debited purchases with the amount it was undercast by and credit sales by the amount it was undercast by. But what we're getting at is an entry was done on the debit side and an entry was done on the credit side with an equal amount that causes your trial balance figure to be our total to agree. All right, so we're going to debit the sales with 100 to remove the extra, and we're going to credit the purchases with the same 100 to remove the extra. Let us look at the ledgers. So our purchases account and our sales account can be found in the general ledger. So in the purchases, you'll recognize that the credit purchases was 7,900, right? It was over by 100, so that is why we credited to remove the $100, so that when we close off the account to the trading account, it is 7,800 and not 7,900. With the sales account, which carries a credit balance, this credit sale was 9,900, which was over by $100, so we debit the sales account to remove that 100, so that when we close off the account to the trading account, it would be 9,800 instead of 9,900. So this is the compensating. They actually cancel out each other because they were on opposite sides. Let's continue to our last error that will not affect our trial balance agreement. So the last one is transposition error. This is where the wrong sequence of an individual character within a number was entered. For example, we were supposed to enter $142, but transposition error took place and we wrote $124. So the 2 and the 4 was swapped. So here is our example. A credit purchase on May 28, 2005 from P. Thomas causing $56 was entered in the books as $65. So we're over because we entered 65 and it should have been 55. Now, on a regular basis, our purchases will be debited and P. Thomas would be credited because he's a creditor. We did a purchase, a credit purchase from him. So purchases would be debited with the $65 and P. Thomas would have been credited with the $65. So we need to remove the excess. And the difference between 65 and 56 is actually 9. So we need to take out $9 out of P. Thomas and take out $9 out of purchases. So we will have to enter it on the opposite side to reduce it. So P. Thomas was already credited with $65, which is over by $9. Purchases was already debited with $65, an excess of $9. So in order to reduce it, to bring it back to the $56, we'll have to do the entry or the correction on the opposite side. So P. Thomas, we put it on the debit side, the $9 to take it from the $65, and then purchases we credit it with the $9 to also take it from the 65 to get $56. So if it was a case where it was short, then we would have done the opposite. We'd have to put it on the side that it is on because of it being short to add it up. But because it was over, so let's say it was supposed to be $65 and they put 56, then most definitely you would have credited the P Thomas with the $9 to add it back up to the 65, and you would have debited the purchases to add it back to the 65 if that was the case. But we are over, so it was overcast, so we're going to definitely have to do the opposite. Put it on the opposite side for P Thomas to reduce it, and put it on the opposite side for the purchases to also reduce it. Our narrative correction of transposition error, purchases made, was overstated by $9. So we overstated, causing us to put it on the opposite side to reduce it. And this would be our ledgers once we post to the ledgers. So purchases would definitely be credited with P Thomas error corrected, PL $9, and P Thomas would have been in the purchase ledger, and we debit it with purchase error corrected. Again, your journal is just a diary telling you what account will be debited, what account will be credited. So we say P Thomas will be debited, and that's what we did. Purchases will be credited, and that's just what we did. So we know which accounts will be debited, which will be credited, and what the detail would be. So throughout the session, you would have heard me saying overcast and undercast. So just to note, casting is adding up figures. Overcasting or overstating is when we incorrectly add up a column or figure to give a result that is larger than it should be. So we add up a column, it's too large, so we overcast it. And then undercasting or understating is where we incorrectly add up a column of figures to give it a result that is less than it should be. So as we were saying with the transposition, we had overcast, and so we'd have to correct it. All right, thank you for watching, and I'll see you next time. Be blessed.